Did you know that the average American carries a whopping $38,000 in personal debt, excluding home mortgages? A staggering fact, isn't it? This figure does not just represent numbers on a spreadsheet. It's a burden that weighs heavily on people's shoulders, stifling their financial freedom and postponing their dreams. Imagine what you could do with an extra $38,000. Perhaps you might take that dream vacation, or maybe even start your own business. But instead, this amount is often tied up in credit card bills, student loans, and car payments. This debt dilemma is more than just an individual problem. It's a societal issue that affects us all. It hinders economic growth and can lead to a cycle of debt that's hard to escape. But there's a silver lining. With the right strategies, anyone can turn their financial situation around. But don't fret. We're about to navigate through the process of saving money, paying off debt, and investing. Saving money isn't about depriving yourself. It's about setting priorities. Let's break down this process into easy, digestible steps. Step 1. Set a budget. This is your financial roadmap. It's about understanding where your money goes and planning how you want it to be spent. Start by jotting down your income and expenses. Include everything, from your rent or mortgage, utilities, groceries, to your morning coffee. Once you have a clear picture of your spending habits, you can start to make changes. Step 2. Cut unnecessary expenses. Look at your budget. Are there things you're spending money on that you really don't need? Maybe you're paying for a gym membership you rarely use, or you're eating out more than you should. These are the kinds of expenses that can be eliminated or at least reduced. Remember, it's not about making drastic changes that make you miserable. It's about making smart choices that can help you save more without feeling deprived. Step 3. Create an emergency fund. This is a safety net for those unexpected expenses that life throws your way. Think about it. If your car breaks down or you have a sudden medical expense, you'll be thankful you have this fund to fall back on. Ideally, your emergency fund should cover 3 to 6 months of living expenses. Yes, it might take some time to save up this amount, but even starting small can make a big difference. Now, let's be clear. Saving money isn't always easy. It requires discipline, patience, and sometimes making tough decisions. But remember, every time you choose to save instead of spend, you're taking a step towards financial freedom. You're not just saving money, you're investing in your future. And here's the best part. Once you start saving, it becomes easier. You start to see the benefits, and before you know it, you're making better financial decisions without even thinking about it. You're setting yourself up for a financially secure future, and that is something worth striving for. Remember, every penny saved is a penny earned. Paying off debt is like climbing a mountain. It's tough, but the view from the top is worth it. Now that we've established the importance of saving, let's dive into how to tackle the debt mountain. There are 2 popular methods to pay off debt: the snowball and the avalanche method. Let's break them both down. The snowball method involves focusing on the smallest debt first, regardless of the interest rate. While you maintain minimum payments on all your debts, any extra money goes to the smallest debt. Once that's paid off, you move to the next smallest, and so on. The idea is to gain momentum and confidence as you see debts disappearing, just like a snowball growing as it rolls down a hill. On the other hand, the avalanche method targets the debt with the highest interest rate first, regardless of the size. You pay minimums on all your debts, but any extra money goes to the highest interest debt. The logic here is that by eliminating the high interest debt first, you save more money over time. This method is like an avalanche, starting slow but gaining speed as you pay off the costly debts first. While both methods have their merits, the best approach depends on your personal situation and mindset. If you need quick wins to stay motivated, the snowball method might be for you. But if you're more concerned about saving money in the long run, the avalanche method might be more suitable. Regardless of the method you choose, one golden rule applies. Always aim to pay more than the minimum payment. Paying the minimum keeps you in debt longer due to the magic, or rather the curse, of compound interest. Targeting high-interest debt first is particularly important because it grows faster. It's like trying to empty a bathtub while the tap is running. The sooner you turn off the tap, or pay off the high-interest debt, the easier it becomes to empty the tub. Paying off debt isn't easy, but it's the first step towards financial freedom. Remember, every journey starts with a single step, and in this case, that step is to start paying off your debts, one at a time. Investing is not about getting rich quick. It's about building wealth over time. Now, let's take a closer look at how this wealth-building process works. Imagine investing as a journey. Your first step is to decide your destination. This is where setting financial goals come into play. Whether it's buying a house, retiring comfortably, or simply growing your wealth, your goals will guide your investment decisions. Next, you need to choose your mode of transport. In investing, this is equivalent to choosing your investment vehicles. Stocks, bonds, mutual funds, real estate, there's a whole world of options out there. Your choice should align with your financial goals, risk tolerance, and time horizon. Now, you wouldn't embark on a journey with only one mode of transport, would you? Similarly, in investing, you need to diversify. That means spreading your investments across different asset classes. This way, if one investment doesn't perform well, others may balance it out. The third step in our journey is understanding the terrain. In investing, this means understanding risk. Every investment comes with its own set of risks. Some investments are riskier than others, but they also offer higher potential returns. It's crucial to understand and be comfortable with the level of risk associated with your investments. The last, but certainly not the least step in our journey is to keep moving forward. In investing, this means investing for the long term. It's about consistency and patience. It's not about timing the market, it's about time in the market. Investing can be intimidating at first, but once you understand the basics, it becomes a lot less daunting. It's like learning to ride a bike. It might be scary at first, but once you get the hang of it, it becomes second nature. So there you have it, folks. Investing is a journey of wealth creation. It's not a sprint, but a marathon. It requires planning, diversification, understanding of risk, and patience. It's a journey worth embarking on, and the sooner you start, the better. Remember, the best time to start investing was yesterday. The second best time is now.